If you follow global finance, you've definitely heard the story. Japan is this ticking time bomb just buried under a mountain of debt. Meanwhile, the US is, well, it's the US, the bedrock of the world economy. But what if that whole narrative, the one we hear all the time, is just plain wrong? Today, we're going to cut through the noise and follow the money to see who the market, the people with real skin in the game, thinks is actually on the brink.
And this is the kind of quote that just pours gasoline on the fire. I mean, think about it. You've got a former prime minister of Japan comparing his own country to Greece. Greece, the poster child for fiscal meltdowns. It sounds like an open and shut case, right? This one quote has pretty much become the cornerstone for how a lot of people see Japan's economy.
So we have to ask, is all this fear justified? Is Japan really about to fall off a cliff? Or is the market, the place where trillions of dollars are on the line every day, telling a completely different story? Let's dig in and see what the data actually says about the world's first and third largest economies.
Okay, first things first. Let's quickly unpack this popular story that paints a very, very bleak picture for Japan.
The headlines are just relentless, aren't they? You see theories about an imminent collapse. You hear these absolutely wild comparisons to Zimbabwe. And then you have those damning statements from politicians. But hey, let's be fair, the US isn't exactly getting a clean bill of health here either, especially with Moody's recently downgrading its credit rating. So yeah, there's a lot of fear and uncertainty to go around.
So with all this chatter, how in the world do we find the truth? Simple. We follow the money.
Look, pundits and politicians can say whatever they want. There are no consequences. But investors with billions of dollars on the line, they don't have that luxury. Their decisions are based on cold, hard analysis. As the source material says, they are severe, honest, and unforgiving. Their collective judgment is probably the most realistic assessment of risk you're ever going to find.
And our first piece of hard evidence from the market comes from something called credit default swaps.
So what on earth is a credit default swap, or CDS? The easiest way to think about it is just as an insurance policy. Big investors buy a CDS to protect themselves just in case a country defaults on its debt. And of course, the company selling that insurance charges a fee, or a premium, for that protection. And here's the part that really matters. It's just like car insurance. If you're a really risky driver, your insurance premium is going to be sky high. Well, it's the exact same for countries. The CDS premium is higher for a country that investors think is more likely to default. So it's simple. A high CDS rate means high risk. A low CDS rate means the market thinks that country is a super safe bet. All right, here we go. This is the market's scorecard for developed nations. Up at the top, no real surprises, right? Switzerland, Germany, the usual suspects when it comes to financial safety. But let's scroll down and see where our two contenders land. And wow, Japan is ranked 5th with a CDS rate of 21. And the United States? It's all the way down at 9th with a rate of 35. Let's put them right next to each other, because the difference is just stark. The market sees Japan as a fiscal honor student, ranking it as the 5th safest nation on this list. The US, on the other hand, is viewed as considerably more precarious. Its CDS rate, the cost to insure its debt, is over 60% higher than Japan's. This just completely flips the conventional wisdom on its head. And oh, remember that Greece comparison? Greece's CDS rate is 47, more than double Japan's. So yeah, that political claim we saw earlier, the market says it's demonstrably false. Okay, so the CDS market is telling a very clear story. But is it just one data point, an outlier? Let's check another massive piece of evidence, the government bond market. This chart just says it all, doesn't it? When a government borrows money, the interest rate it has to pay is called the yield. Again, think of it as the price of borrowing. If you're seen as risky, you have to offer a bigger reward, a higher interest rate to convince people to lend you money. The US pays 4.5% interest on its 10-year bonds, and Japan, a tiny 1.5%. That is a massive difference. Let's be real. If investors truly believed Japan was about to have a fiscal collapse, they would be demanding a huge interest rate to compensate for that risk. The fact that they are willing to lend the Japanese government money for 10 years at a tiny 1.5% return, well, that tells you everything. It proves the bond market sees Japan's risk of default as extremely low. Both the CDS and the bond markets are screaming the exact same thing. Now, all this data is really compelling, but let's ground it in the real world with the actions of maybe the most respected investor on the entire planet. Warren Buffett. He's been really vocal about his concerns over the US fiscal path. But he's not just talking. His actions are what's really interesting.
While he's sounding the alarm on the U.S., his company, Berkshire Hathaway, has been making huge long-term investments in major Japanese companies. You know the saying, actions speak louder than words? Well, his actions perfectly align with all the market data we just saw. He's betting that yen-based assets are a safer harbor than dollar-based ones. So, the market's verdict seems crystal clear. Japan's finances are stable. But this comes with a really, really important final clarification. Now, to be perfectly clear, saying Japan isn't on the verge of some catastrophic collapse is not the same thing as saying its government spends every yen perfectly. Not at all. A country's finances can be totally stable even if the government is being wasteful. Stability and efficiency, they're two very different things. And that, right there, brings us to the real debate. The market has given its verdict on the risk of collapse. The much harder question for citizens and policymakers in both Japan and the US isn't about whether the government will go bankrupt. It's about how to best use the limited public funds we have to create the most value for society. And that's a question we should all be thinking about.